All right, let's dive into a really fascinating story from the third quarter of 2025. We're looking at one of the world's biggest glove makers, Sri Trang Gloves, or SGT. And here's the puzzle. They sold a record number of gloves, but their profits completely disappeared. It's a real head-scratcher, and we're going to break down exactly what went on. Let's get into it.
So we're not going to bury the lead? Let's just put the bottom line number right out there. For the third quarter, STGT posted a net loss of 106 million Thai baht. Now, for a global giant like them, any loss is a big deal. But what's really interesting isn't just the number. It's how in the world they got there.
And this brings us right to the heart of the matter, the big paradoxical question for today. How on earth does a company that's selling more stuff end up losing money? It just doesn't feel right, does it? But the answer tells us a whole lot about the powerful forces at play in the global market right now.
To really get our heads around this, you've got to see this quarter as a tale of two completely opposing stories. You've got a booming top line clashing with a collapsing bottom line.
This slide just lays out the whole contradiction perfectly. On one hand, sales volume, that's the actual number of gloves they sold, is up a really solid 10.7%. That's great. But then you look at the other side, and net profit didn't just drop, it absolutely cratered by over 237%. It completely wiped out the profit from the last quarter and pushed them into the red. So let's unpack this, starting with the good news.
So the bright spot in this whole story is pretty straightforward. STGT is moving an incredible amount of product. I mean, the demand is absolutely there.
And the numbers, they're just staggering. They sold over 10 billion gloves in just 3 months. This is a massive, massive operation that is successfully meeting huge global demand. So what was driving this surge?
Well, this growth wasn't just some accident. It was all about renewed confidence in the market. A huge piece of the puzzle was getting clarity on the U.S. reciprocal tariff. This was a trade policy that had basically put a pause on a lot of buyers. Once that uncertainty was cleared up, boom, the purchase orders just came flooding back in. So the key takeaway here, the sales engine is firing on all cylinders.
Okay, so if the sales engine is running at full throttle, where did all the money go? Let's dig into the 3 big pressures that turn those record sales into a net loss.
Here's our roadmap for the rest of this story. It really boils down to these 3 things. First, just brutal competition squeezing how much money they can make on each glove. Second, the currency markets decided to work against them. And third, and this one's a real kicker, they had a major one-time accounting charge that just completely blew up the final number. Let's take them one by one.
First up, their profit margins got seriously squeezed. The gross profit margin, which is basically how much profit they make on the gloves themselves, dropped from 8.6% down to 7.2%. Now, why did that happen? Well, the market is just flooded with supply after the pandemic, and that means intense competition. They had to lower their prices to compete, and those price cuts were bigger than any savings they could find in production.
Second on our list is foreign exchange. See, SGT is a Thai company, so their costs are in Thai baht, but they sell all over the world in currencies like the US dollar. During this quarter, the baht got stronger. Now that might sound like a good thing, but if you're an exporter, it's not. It means every single dollar they earn from a sale converts back into fewer baht, and that directly eats away at your profits.
And now we get to the final and honestly, the most dramatic part of the story. Before any weird one-time accounting stuff, STGT was pretty much breaking even. They had a tiny pre-tax loss of just 500,000 baht. So what was the knockout punch? A huge one-time impairment charge. This is an accounting move where a company has to write down the value of an asset, maybe a factory, because it's no longer worth what it says on the books. This single on-paper decision is what turned a break-even quarter into that 106 million baht loss.
So with a quarter like that, you might be thinking, wow, this company must be in serious trouble. But this is exactly why it's so important to look beyond just one quarter's income statement. When we switch gears and look at their balance sheet, which is like a snapshot of the company's total financial health, a much, much more reassuring picture emerges.
So here's the crucial point. One rough quarter does not define a company's stability. The underlying financial foundation of SGGT is actually exceptionally strong, and we've got the numbers to prove it.
Let's start with their net debt-to-equity ratio. It's sitting at an unbelievably low 0.03 times. So what does that even mean? It means for every dollar value the owners have in the company, there's only about 3 cents of net debt. This is a sign of a super conservative, really resilient financial structure. They're not over-leveraged at all.
Next up, their current ratio is a very healthy 2.4. This tells us that the company has 2.4 times more short-term assets, things like cash and inventory, than it has short-term bills to pay. Simply put, they have more than enough cash on hand to cover all their obligations for the next year. No problem there.
And finally, their interest coverage ratio is a powerful 9.9 times. This shows that their earnings are almost 10 times higher than the interest payments on the little debt they do have. There's absolutely zero concern about their ability to pay their bills. The foundation is, well, it's rock solid.
A strong foundation is fantastic, but management knows they can't just stand still. They have a very clear plan in place to tackle this profitability challenge and get the company moving in the right direction again. So let's take a look at their strategy for a rebound.
Their game plan really rests on 4 main pillars. First, they're leaning into automation and even AI to make everything more efficient and cut costs. Second, they're optimizing their existing factories to squeeze every last bit of profit out of their production lines. Third, they're pushing to expand into new countries. They're already in 175 of them. And fourth, they're focusing on specialty product lines that have higher profit margins. It's a really comprehensive approach to both efficiency and growth.
But that's not all they're doing. The company also announced another major strategic move, a share repurchase program. And it's exactly what it sounds like. The company is taking its own cash and using it to buy its own stock from the open market.
So why would they do this? Well, it's a massive signal of confidence. Management is basically telling the world, we believe our stock is undervalued right now, and the best investment we can make is in ourselves. By reducing the number of shares out there, they automatically give a boost to key metrics like return on equity and earnings per share for everyone who still owns the stock. It's a bold move that shows they believe in the company's future.
So after digging through all of this, we circle right back to where we started. The story of STGT's third quarter is the story of this one fundamental challenge. The demand is there, the sales are definitely strong, and the balance sheet is solid as a rock. The entire puzzle is just about figuring out how to convert that top-line strength into bottom-line growth in what is a fiercely competitive market.
And that really leaves us with the final question, doesn't it? We know the company is financially sound. We know they have a plan. But will that be enough to overcome these intense market pressures? The answer is going to show us whether STGT's future looks more like its booming sales or its disappearing profits.